Welcome to MarketTamer again. We've got a little bonus for those of you who are not members today. Just a quick lesson on how to generate some additional capital from stocks that you own. And really the first place to begin is to ask yourself, what historical return have you produced in the markets? Because a lot of us see big advertisements. We see things like shoot for 100%, 200%, 400% gains. And these are all possible, but usually they require missing a lot of other trades in the process. For example, if you put 99 trades on, there's a pretty decent shot that you'll make a 100% or 200% winner. But that's not necessarily a good way to trade, because the aggregate result of all the other trades could be losers. So let's think about what we should be focusing on when we're trading, and really what we should focus on is creating attainable goals. As we become increasingly aggressive with respect to the goals we set, we find that the risk levels increase accordingly, and so we must always pay very special attention to our own risk levels. How much can I tolerate? Can I sleep at night? More specifically, if we look to the past, we'll see a really interesting statistic from Jeremy Siegel in The Future of Investors. He stated that from 1871 to 2003, reinvested dividends accounted for 97% of the real return of stocks. Capital gains accounted for just 3%. So the question is, should we only invest in dividend-paying stocks? It certainly seems that way from that quick statistic. Another question we might ask, are investments in dividend-paying stocks the only way to outperform the stock market? And what should we do if we own stocks that don't pay a dividend? Well, to all those questions, we have answers. And a quick answer on all of these is to look to combine options with stocks. For example, if we have bearish options instruments, we can take advantage of stock market declines. If we just have a buy and hold strategy, that's not possible. In addition, if we use options, we can take advantage not just of bullish and bearish markets, but of stagnant markets too. So if we don't have dividends, that's no problem. Options afford us the opportunity to lower cost basis on existing stock positions and to produce a regular income. And the way we can do that is through a strategy called the covered call. It's probably one of the simplest strategies out there. It involves simply combining a short call option with a long stock. The long stock, as we know, is a bullish position. We make money as stocks rise. But the short call is a bearish position. It takes advantage of declining markets. For example, let's say we had a $50 stock. We purchase 100 shares of it, and we also have a strike 55 short call, one contract. If we spend $5,000 on the stock, we can take in this example, $100 of credit on the short call. So when we find the stock reaches resistance levels, let's say that's $55 per share, we could potentially short a call option near that strike price, take in some premium. We can effectively lower risk on the overall trade. We can generate some cash flow. And there are so many different ways of applying this trade that we won't go into any of them really in this example. We'll just introduce the concept of the covered call. But be sure to know that this is one of the most powerful ways of generating cash flow on stocks that you own, and it should really be part of any investing strategy that takes advantage of proactive shorting of options to generate cash flow. If you're interested in learning more, feel free to come over to MarketTamer.com, and we'll be happy to explain more about the covered call and many other strategies.